Hello, everyone. Welcome to the July episode of First Look ETF. I'm Stephanie Stanton. 2026 is already half over, and the ETF market isn't slowing down. New launches, evolving investor preferences, and massive asset flows are reshaping the industry in real time. Coming up, markets swing, investors flinch, and long-term plans fall apart. We're going to tell you about a new ETF that aims to break that cycle with a systematic hedge that keeps investors participating without feeling exposed. Also, we will examine a recently launched ETF from T. Rowe Price that aims for dependable income while limiting downside risk. And finally, we will uncover a pair of bond ETFs from Loomis Sayles designed to navigate rate volatility and yield uncertainty. Before we go any further, we want to welcome Ethan Hertzfeld with the New York Stock Exchange. Ethan, thank you so much for joining us.
Stephanie, thanks for having me. Good to see you guys again.
Yeah, great to see you. We want to begin, as we always do, with the latest update on ETF launch activity. How's everything looking?
June was an incredible month leading up to our July episode here. More than 200 ETFs were launched in June. It's the largest month by ETF launch volume ever. We're up over 700 ETFs year to date at the midpoint, putting us well on pace, especially considering that Q4 tends to see a significant uptick in listings to be significantly above last year's record of over 1,100 ETFs, well on pace to beat that again this year in 2026.
Fantastic. You know, it is hard to believe that 2026 is already half over. As we look ahead to the second half of the year, what ETF trends are you also monitoring?
Like I mentioned last month, continue to see active, still over 80%. We've seen active in June crest a 1.5 trillion in AUM for the first time ever. So that's really exciting news on that front. I don't think we're seeing any slowdown in launches there. We've obviously also seen some really cool innovative products in the last 30 or so days, especially with the SpaceX IPO and a lot that's come along with that. And I don't think that's going to slow down as we see more unicorns come to market over the next few months.
You know, we have a great guest lineup today, as we always do. What are you looking forward to on today's show?
Yeah, I think we have some new exciting products from existing issuers. We have a new issuer joining us this month with their first ETF listed in the United States. So some really exciting stuff to highlight, some new and innovative products, especially at a really interesting time in the market.
All right, we'll leave it right there. Ethan, thank you so much for the update. It is always a pleasure to see you, and we'll see you soon.
Thanks for having me, Stephanie. It's been a pleasure.
Thank you. And just a quick reminder to watch First Look ETF on Apple TV, Amazon Fire TV, and Roku. We also simulcast First Look ETF on iTunes and Spotify, so don't miss it. Investors want income more than ever. But every time markets wobble, fear persuades them to sit on their hands. It's the age-old dilemma, craving yield while being terrified of the timing. Well, here to discuss one possible ETF solution is Farris Shuggi, head of quantitative equity at T. Rowe Price Investment Management. Farris, it is great to have you.
Thank you, Stephanie, for having me on.
You're very welcome. So T. Rowe Price recently launched the Capital Appreciation Market Opportunities ETF, and your ticker is TPUT on the New York Stock Exchange. So first of all, congrats on that.
Thank you.
So how does TPUT solve the dilemma of an investor who wants equity exposure and income, but then maybe too afraid to deploy their sideline cash during market drawdowns?
Thank you. It's a great question. So we're very excited to bring this strategy to market. TPUT is a cash deployment ETF. So at its core, the strategy holds cash and short duration treasuries and uses those assets as collateral to write deep out of the money put options in a laddered fashion on the S&P 500. We do this with the aim of achieving three goals. The first is earning additional income above the risk-free rate. So the put writing program that we've built into the portfolio earns an additional 2 to 3% yield on top of the risk-free rate. So today, TPUT would have an all-in yield of about 6%. The second objective is to opportunistically invest in equities right after the market has had a significant pullback. Our research shows that conditional on the market falling 15, 20, 25%, the forward returns on the S&P 500, 9 to 15 months out, become very attractive. Risk-adjusted returns improve, average return goes up, and the risk of loss goes down. But as you noted, oftentimes investors are scared at those moments. TPUT has this feature of auto-rebalancing because of the put options, where investors will start to get equitized as the market falls to those deep levels, and those are going to be really attractive points to enter the market on a go-forward basis.
Let's go back to when you talk about the yields and some of the differences. Break it down for us. How does TPUT compare then against a standard money market fund or a traditional ultra short bond ETF?
So with a traditional money market fund or ultra short-term bond fund, you're going to earn the risk-free rate and then maybe 50 to 75 or 100 basis points, depending on the amount of credit risk in that strategy. TPUT, you're going to earn a higher yield than that. You're going to earn the risk-free rate plus an additional 2 to 3% from the put writing, which is driven by equity volatility. And then you're not going to have any credit risk. You're going to have some equity exposure because of the short put position. So we view TPUT as a complement to a traditional money market fund. So imagine you have an investor who looks at the market today and says, this market is really full and valuations are very elevated. And I'd like to de-risk my portfolio a bit, but I'd be willing to buy equities if the market fell 20 or 25%. TPUT is ideal for them, and they can take some of their cash allocation and allocate to TPUT.
So then is that how you see TPUT deployed inside a diversified investment portfolio alongside other holdings?
Yes, that's an ideal use case. Another use case is imagine you have a traditional balance strategy that's 60% equities and 40% fixed income. If the market falls 20%, you don't have 60% in equities anymore. And then at that point, one of three things is going to happen. In the worst case scenario, investors panic and they reduce their equity exposure further. The most likely scenario is they do nothing, but then the problem with that is they're under indexed to equities for the recovery. Ideal situation, they rebalance back to 60 or even better to 61 or 62% at that point. And TPUT, if you include it in a traditional balance strategy, helps with that exercise, and it removes the emotional aspect of buying the market after a significant pullback.
Makes a lot of sense. All right. Well, we're going to leave it right there. Farris, Shuggi, thank you so much for joining us and sharing more about TPUT. We appreciate it.
Thank you.
Fixed income investors are getting squeezed from all sides. Rate volatility, stubborn inflation pockets, and unpredictable credit spreads have turned safe income into a moving target. Well, are there any ETF strategies that can potentially help income investors overcome some of these challenges? Let's get to the bottom of it and welcome Nick Elward Sr., SVP, Head of Institutional Product and Head of ETFs at Natixis Investment Managers. Hello, Nick. It's good to see you.
Thank you for having me today.
So before we dive into your recently launched bond ETFs, what are some of the challenges today facing fixed income investors?
Yeah, for sure. I think there are a couple, one being investment challenges, and I think it all starts with the ending of the long period of near zero interest rates. We're getting to the period of rising interest rates, credit conditions are changing, and maybe in some way becoming more distressed in certain areas of the market. Volatility can emerge pretty fast, sector by sector, so that's really complex for investors. Beyond that, as we look at the traditional bond benchmarks that many investors own, so passive investing, a lot of the opportunity set that those indices have access to seem to miss some opportunities. Certain areas of high yield, crossover securities, and definitely securitized credit. And also, as we look at passive investment, a lot of times you see passive ETFs or mutual funds underperforming their active brethren. So that too has been a challenge for investors. So that's why we've seen more interest in active products. And beyond that, the other challenge has been just keeping things simple and looking for liquidity for financial advisors. And with that, we know active ETFs can help.
So your firm recently introduced the Natixis Loomis Sayles Total Return Bond ETF. Your ticker on that one is LSTB. You also have the Natixis Loomis Sayles Dynamic Core Plus ETF, and that ticker is LSCP, both ETFs listed on the NYSE, so congrats on that. Can you break down the strategies, the differences between these two bond ETFs, and then explain how they complement one another?
Yeah, I'm happy to. The two portfolio management teams that run these two ETFs have extensive experience running similar strategies and other vehicle types. As an example, both teams run a similar mutual fund, and combined those mutual funds have $26 billion in assets. So they're very established, they're very proven over time in other vehicle types. The two ETFs sit within the intermediate core plus bond category, which is a category that's quite large within the fixed income ETF space. It's also a category that's often utilized as a core fixed income allocation for investors. So it's really a meaningful category. So we wanted to focus on a really meaningful category as we began our quest, if you will, into the ETF space on the fixed income side. Now, the two ETFs themselves, so LSTB is the more flexible of the two strategies. It's managed by the Loomis Sayles full discretion team, and it follows a benchmark agnostic approach, really value-driven, focused on bottom-up credit research. And again, that flexibility is intended to provide stronger returns than most, but obviously taking on more risk than some. The objective is absolutely total return, again, income generation and capital appreciation being the source of that return. Now, LSCP, on the other hand, takes a different approach. So two different ETFs for two different buyer types. This is managed by the Loomis Sayles relative return team, definitely more benchmark aware with tighter risk controls and an emphasis on consistency, greater consistency versus the high return potential of the other ETF. So they dynamically invest across different sectors and again, looking to be in the right place at different times in the credit cycle. So those are the two key differences. Again, one being more opportunistic, one being more of a core portfolio, both sitting in that intermediate core plus category.
So how do you envision advisors and investors potentially using each of these ETFs within their overall portfolio?
Yep, for sure. I do think, as I said, the category is a crucial category for investors. It oftentimes takes up the bulk of the assets as advisors allocate portfolios. So again, we want to focus on this and provide two choices within that space for advisors. So for those advisors seeking that opportunistic, more flexible, higher return potential strategy, then obviously LSTB is a solution for that clientele. And LSCP would be more in line for those that want more of a smoother ride, a core bond allocation type of position, and again, more risk managed to the point where, again, you'll have that smoother ride. So those are the ways I believe that investors would use these two portfolios differently.
All right, we will leave it right there. Nick, thank you so much for joining us here on First Look ETF and breaking down your brand new ETFs. We appreciate your time today.
Thank you so much for having me.
Markets swing, investors flinch, and long-term plans fall apart. The Toews Agility Shares Hedged Risk ETF tries to break that cycle with a systematic hedge that keeps investors participating without feeling exposed. Joining us now to elaborate is Phillip Toews, CEO Toews Asset Management. Phillip, it is a pleasure to have you.
Amazing to be here, Stephanie.
So before we discuss your recently launched ETFs, what are some of the challenges that you see facing investors?
Well, the biggest challenge, Stephanie, is the one that we're all aware of, but we don't know where we are on the risk scale. So most investors and advisors would agree that we're in some part of the late stage of a bull rally. You could argue that we may have another 6 to 12 months. Maybe it could go up significantly. But there's also the possibility, especially if we see this bubble escalate further, that we could have the crash. And so it's easy to forget about that during a bull market. But the key challenge, if we all understand that at some point over the next 12, 24 months, there could be a significant downturn, is what to do about it. And so that's where HRSK could potentially play a role.
And your firm recently launched the Toews Agility Shares Hedged Risk ETF, that ticker HRSK. You guys began trading on the NYSE, so first of all, congrats on that. Tell us some more about the fund's strategy and the types of holdings it targets.
Well, the first thing I want to mention is that we launched this ETF via 351 exchange, which is super exciting. And I won't go into too much detail about that, other than to say that advisors who had investors with highly concentrated positions could line them up, and then they appear in our ETF on day one as an automatic seed. So there haven't been too many of those done, but we accomplished it. So let's talk a little bit about the strategy. So there are a couple of key objectives that I think investors should have. The first is you want to have somewhat reliable up capture to equities markets. Number two, if you have a hedged equity product, you want to have a hedge, in our opinion, Stephanie, that grows stronger as market crises escalate. So that's really important. And then a third component would be you want to try to pay for that hedge. And number 4, it should all be dynamically managed. So the one thing that's out in the marketplace right now, there are a lot of products that are buffered for the first X% of a decline, or that have hard calendar-based caps. We think that's potentially a problem because you can rise to the cap and then have no more gains for the rest of the year, or you could fall below the buffer and then free fall along with significant declining markets. So HRSK is designed to address all 4 of those components. We have a full S&P or like exposure. We have a full notional hedge farther out, about 2 years on a put. We pay for that with shorter dated calls and put spreads. And then as the market evolves, the entire option overlay is dynamically managed. So what does that mean? It means that if you're an investor or advisor and you want a hedged equity component, you can set it in the portfolio and not have to come in and course correct along the way.
So yeah, and along those lines, then when you talk about the investors and advisors that HRSK could appeal to, dive into that a little bit more. Give us some more examples of that.
How does it fit? Well, we believe, I relentlessly pitched my book, The Behavioral Portfolio. I laid out an approach to how portfolios should be built to both embrace optimism about market growth, but also address the contingencies of significant downturns. And so what we recommend is that advisors and investors use hedged equity strategies generally, not necessarily all HRSK, but hedged equity strategies as much as 50% of an overall equity portfolio. So let's say you have 70% up capture with that strategy and 100% in just conventional equities. That means you're looking at about an 85% overall up capture scenario. But that also then that becomes very important when markets fall. So if you can have hedged equity strategies for enough to matter and potentially very low down market correlation during severe crises, it can really help investors navigate that and ultimately avoid some economic pain, especially if they're taking distributions during retirement.
Yeah, and quickly before we let you go, Felipe, you mentioned your book. Can you show us again and tell us how we can get a copy?
So it's titled The Behavioral Portfolio. It's available everywhere. There's an audio version. So please check it out. Thanks for replugging that.
Felipe, thank you so much for your insights. Best of success with your latest ETFs. It's great to have you on our show today. And that wraps up this edition of First Look ETF. If you enjoyed the episode, please let us know in the comments section and hit that like button. Want to give a big thanks to all of our guests, including Ethan Hertzfeld and the team at the New York Stock Exchange. For more ETF insights, you can visit etfcentral.com. I'm Stephanie Stanton with ETFguide. Thanks for watching. We'll see you next time.